Scalping involves executing multiple short-term trades during periods of high volume to quickly gain profits. However, it requires careful risk management due to the potential for significant drawdowns. In this video, we're going to explain one of the best scalping setups that we've developed using smart money concepts step by step on the chart. By the end of this video, you'll be able to analyze the candlestick chart like a professional smart money trader and apply this technique to execute a perfect trade in lower time frames. If you enjoy learning advanced trading strategies and enhancing your trading skills, smash the like button and subscribe to our channel for more trading content. This trading setup utilizes two time frames, 15 minutes and 5 minutes. We have divided this trading setup into 4 simple steps. Step number 1, find the direction and key levels in the higher time frame. Step number 2, find the direction in the lower time frame. Step number 3, identify the fair value gaps that are inside the discount zone. And finally, execute the trade. So basically, this trading strategy combines concepts of market direction, multi-time frame analysis, fair value gap, and entry method. It is worth mentioning that since this is a scalping strategy, it needs to be used with a proper risk management plan to maximize efficiency. Now let's move on to the steps. Find the direction and key levels in the higher time frame. We need to mention that this trading strategy is a trend continuation strategy, so we only use it when we can clearly identify the market direction. Now, how do we identify a clear moving market? In an ideal uptrend, the market continuously makes higher highs and higher lows. Every time the market breaks a higher high to the upside, we call that a break of structure, indicating the market tends to continue in the same bullish direction. On the other hand, if the market breaks a higher low to the downside, we call that a change of character, signaling a possible trend change. A valid change of character occurs when the price breaks and closes below a key swing low. A key swing low refers to the lowest point between 2 consecutive highs. Here we have 2 consecutive highs, so the lowest point between these two is our swing low. As long as the price stays above this level, it represents a bullish market, and we will only look for buying opportunities. For a valid change of character, we need to have a candle break and close below this level. Keep in mind that the same concept applies to the bearish scenario. The second thing we do after identifying the market direction on the 15-minute chart is to mark key levels. Usually, there are 3 major criteria that we look for when identifying these levels: the most recent market structure and multiple rejections acting as both support and resistance. These levels are considered key areas on the 15-minute chart. In the second step, we zoom into the 5-minute chart and apply the same principles to identify the market direction. The important point here is that we want the higher time frame and lower time frame to be in the same direction. For instance, if the 15-minute chart is bullish, we want the 5-minute chart to also be bullish. This way, we can look for long opportunities with confidence, as the direction of both time frames is aligned. Now, after identifying our trading bias, it is time to mark the fair value gaps. Essentially, the fair value gap refers to the space between the wicks of 3 consecutive candles on a price chart. Regardless of the candle's color, in the bullish scenario, when the upper wick of the first candle does not overlap with the lower wick of the third candle, we mark this area as the FVG. Now, what does it signify in terms of price action? It shows a buy-side imbalance where the buying pressure has significantly outweighed the selling pressure, possibly due to institutional activities. Now, the market has entered a phase of inefficiency, which usually leads it to return to the fair value gap area to rectify them. Let's identify the fair value gap areas in this example. This is our latest impulsive move starting here and pushing all the way up to here. Here we have a gap between the wicks, so we mark it in. Here we also have another fair value gap between the candles. When the price pullbacks and taps into these fair value gap areas, they are going to act as support and reject the price to the upside, which will provide us a perfect trading opportunity. But there is a significant difference between these two. If we apply the Fibonacci retracement tool from the start of this impulsive move to the end, we can notice that this FVG is located below the 50% level, which is the discount zone, and this one is located above, which is the premium side of the range. We are only interested in buying in the discount zone and selling inside the premium due to multiple reasons. Usually, the market loves to take out the early buyers. So, a more conservative way to enter the long trade is to wait for the price to enter the discount. This increases the chance of success and reduces the chance of being the victim of a liquidity grab. Now we reach the final step, which is executing the trade. We know that our entry must be somewhere inside this fair value gap. But here comes the question. Where is the safest spot to set our stop loss to be protected from price fluctuations? The safest spot is below this swing low. However, sometimes if we set our stop loss below this candle, we would have a large stop loss. So we need to create a balance between our entry and exit points. So let's see some real chart examples to show you how we apply all of the concepts from start to finish. Here on the Euro-Dollar 15-minute chart, we have an uptrend in motion. These are the latest breaks to the upside, indicating our higher time frame bias is bullish. Now let's zoom into the 5 minutes. On the 5-minute chart, we are also witnessing a bullish market, with the latest impulsive move starting somewhere around here and extending all the way up to here. We can identify two fair value gap areas, which are considered our trading zones. However, if we apply the Fibonacci retracement levels, we can see that only the lower one is placed inside the discount zone. So, we only look for trades on that one. Now, we can place a buy order at the start of the fair value gap area and put our stop below the swing low. Our first target is the nearest high in front of the price, and we can target the higher time frame key levels for our next targets. Here on the gold 15-minute chart, we have a clear downtrend in motion. So our overall bias is bearish, and we are only looking for sell opportunities. Let's zoom into the 5 minutes. On the 5-minute chart, we can identify this small area of fair value gap, which is located inside the premium side of the range. So it is our supply area to go short. We will open a short position at the start of the FVG zone and place our stop above this wick to be protected. For profit, we can aim for a solid 1 to 2 target for this setup. But remember, since we have a very tiny supply zone, we need to keep our stop loss large. This FVG area is an optimal place to open a short position, but being rejected exactly from this box is not a rule. The market can easily ignore this area and reverse from higher prices. So traders, I hope this video was useful to you. If it was, please hit the like button to help us in making more videos like this and subscribe to our channel if you are new. See you in the next episode.